Hello, this is Sam Celery for Celery Signals, and we are going to be discussing exposure. Celery Signals, as a part of our proprietary set of icons, signal, momentum, and exposure, has one set of our internal algorithms specifically designed to produce the exposure recommendation of Celery Signals. And it is built to judge the general 1 to 3 year bullish or bearish trend of a security, and therefore provide a dynamically changing risk-adjusted metric, if you will, to as to what level of exposure you should take on that security relative to your allocation that you've designated. So whether your allocation is 2, 10, 50%, whatever it is, what is the exposure of that allocation in your portfolio relative to the general trend of a security you should take? That is what Celery Signals exposure is. So let's take a deeper dive into that. Let's get this out of the way here. So you see a rising upward trend. So in a rising bull market, and again, we're looking at the S&P index, our exposure calls will be 100%, okay, in a rising environment, all right? So this is saying at whatever your allocation is, if you need to get in a security at 100% exposure, that means get your allocation involved at 100%. A 50% exposure is what you'll see on an exit arrow in a bull market environment. So what is this telling you? This is telling you if you are a buy and hold style of investing, investor, that this doesn't mean you will never take, or you don't want the information that suggests when there is near-term volatility in play. And that's what these 50% down arrows are telling you if you are on the buy and hold or longer term investing type side of the spectrum. Identifying near-term volatility, if it persists, I need to pay more attention, but the likelihood is that the rising bull market environment will re-involve itself or re-engage within the next few weeks, which again, if you bypass a 50% exit arrow, then you bypass the 50 or the 100% entry arrow because you're already long the security. Now, if you are, say, a professional money manager managing a risk-adjusted style of portfolio, or an individual who's more risk-averse, okay, you're going into retirement, you are in retirement, getting every ounce of return out of a particular security is not your highest goal, but more of a risk-adjusted approach. You need something to identify some level of hedged exposure. Then you would most certainly want to take a more action or pay attention to these 50% exposures, which don't look like a whole lot on the S&P 500, but very much make a lot more sense on an individual security that can have, volatility swings of 10 to 30% within a handful of weeks. So that's what it looks like in a rising environment. Now, let's look at it in a consolidated top. Okay, so we're coming off this rising environment here in the S&P, and we're consolidating at the top of 2015-16 into a bearish segment here in middle of 15 and the middle of 16. So you can see that the 100% entries still exist. That's because the longer term algorithm is saying, hey, we still recognize that the price is trying to rise. But you can see how our exits are going from 50% to 0, 50, 0, 0, 0, and finally the market rolled over 10 or 15% correction in a matter of a month in middle of 2015, and we had a 0% exit arrow. So that's saying get out of this position, go to another security, go to the sidelines. We see greater levels of volatility in play. So if you're a buy and hold investor, you definitely want to pay attention to the 100% entries, 0% exits. Those are your key icons. from an exposure standpoint. Those are when the bigger actions are going to take place. Doesn't mean they're going to work out every time, but they are telling you that bigger moves may be on the horizon. Now, moving into a bearish segment of the market, middle of 15 and the middle of 16. Okay, you just invert the process. In a bearish environment, we're going to start with 50% entries, and if upward, if the market or security continues to move in an upward position, we are going to add to that dynamically. Okay, here's something I want to point out to you. So you see this horizontal line here, which is meant to identify a general price horizon to you. We have a 0% exit here, a 50% exit here, and a 50% exit here, all relatively at the same general price. Yet one is saying get out of the market completely, 0% exit, and the other two are saying consider a hedged bet or near-term volatility in play. So this is what the algorithm does, and what it does very well on a dynamic basis. Okay, prices generally at the same level within a 12-month period, and yet one is saying get completely out, and the other one is saying heads up. How does it do that? Well, again, it judges the general, broader, directional strength of a security, and that's what we provide to you through exposure. Now let's take a look back here at 2008 just to close this out. So here we are, 50, 100, 100, 100, 50s. Now we get into October 2007, and boom, you pay attention to the algorithm, it starts changing right in front of you. You're a buy and hold guy, or even if you're a risk averse individual, here we go, we're into 0% exits, 50%, and it just really helps offer you those decision-making points of action that are so difficult to come by. Doesn't mean it's going to be right all the time, but it is there for you. And then, of course, here we are at the bottom of 2008, 2009, and we start getting long again with pretty good consistency, just 2-3 weeks right after the bottom. So that's Celery Signals Exposure. Thanks for watching.